Good evening, everyone. This is Saju, a product manager, mutual fund HDFC Securities. Sincere apologies for the delay in starting this webinar. I request you all to hold on. We are about to start the webinar.
Hi, can you guys hear?
Vishal, yeah, we are able to hear you. So do you
Okay.
want to share your screen?
Yes, I will. Just give me 1 second.
Sure.
Hi. There were some issues in connecting. Just give me a second.
Sure. Vishal, do let us know once you're ready.
Hi, I don't have the permission to share the screen.
Omkar, can you check this?
Yeah. Otherwise, I'm fully ready. I'm just starting my video.
You are able to share your screen, right?
No, I'm not able to share my screen.
Okay. Omkar,
Vishal, you're able to click on the green share button, and then
Yeah,
after,
I can see the green share button.
okay, because you have all the rights, I have given you all the rights. Access and control.
No, but when I try and click the green share button, after that, the option that I get, it doesn't move ahead. It shows me an option to either share the entire screen,
Yeah,
which
you
when I
have to
click,
set the task screen over there.
I'm trying to click on it, but it doesn't move ahead after that.
This-
So I'm trying to share my entire screen. It's showing me three options: Microsoft Edge, window, and entire screen. I've tried all the three. So
After
it goes,
selecting that, you have to click on share. Below share button will be there.
but it's not the share option that I get is shaded. It's not active. Can you check at your end if?
Actually, I'm giving all the rights to everyone. Saju also have the same rights, so
Acha,
you can do that. Okay.
and
Vishal, just check on one of the option to share your entire screen and then check if
I,
the share Uh,
I tried all the three options, but none of the options. Just give me a second. I'll just call my IT guy and let me check. Yeah.
So organizer
Hello. Hello, Vishal. Oh, access of the
yeah, Vishal, we are able to see the screen, the slide.
Hi.
Yeah.
So, my apologies for the inconvenience caused and for the inordinate delay. There was some delay because of this IT issue, but yeah, let's start. So, significant amount of volatility for the markets, and for the last few days, we were seeing this volatility only in equities. Sorry, just checking. You guys can hear it clearly, right?
Yes, Vishal, we are able to hear you.
Okay, okay, continue. Thank you. So, so for the last few weeks, I guess the volatility was primarily constrained to equities, and of late we have seen the volatility across the asset classes, right? And we've seen volatility in currencies, in fixed income markets. Credit spreads have increased. So now it's turning out to be a full-fledged pain that is there across the global economy. And just a while back, China has retaliated to the US tariff imposition. China has announced a 34% tariff on a slew of imports from the United States. US had levied a tariff and on China that amounted to 54%. And now there'll be, China has retaliated with 34%. Europe is expected to place retaliatory tariff on the US. So, and Europe is actually more scary because China is still on the tariffs are on goods. Europe has Europe has suggested that they might even tax services. US is the largest exporter of services globally. If you see all the like Twitter or Google or Amazon or Facebook and the various apps of Facebook is the largest, but there are several smaller apps that are run by Meta. All of this counts under is counted under services, and till now globally services have not been taxed. So if Europe actually goes ahead and starts taxing services, then it could have a lot of ramifications. So this is a thought. I thought I'll just give you a brief as to what is going on, and I will delve more on this as we go ahead. So I'll just start with my presentation as to how I am evaluating the global equity markets. So there are so the way we think, right, as Bandhan Mutual Fund, the way I think in managing my funds, there are some longer term trends that we feel will play out. There are some medium term trends, and there are these short term volatile trends that keep impacting the returns in general. So I'll take you through some of these as to how I approach fund management. So Indians are traditionally under allocated to equities. We have considered equities very risky. And even after seeing that equities have given the best return for the last 30, 40 years, right? Even then, we assume there's a perception that equities are risky. Equities are definitely risky in the short term, and when we mean risk, as to what do we exactly mean by risk, right? Risk is loss of capital, and in most cases it is permanent. So this permanent loss of capital is actually the real risk. But the way textbooks define risk is uh, in terms of volatility. That if equities are more volatile, then they are classified as more risky. But in the long term, when all of these things are taken care of, a lot of these short term measures are taken care of, the volatility is compensated by the way of higher returns. And even after that, we have not invested, as Indians, we've not invested much in equities. So this will gradually improve as financialization and financial literacy increases. There will be a tendency. There will be we might be more the propensity to invest will increase, and that will create a lot of flows for the equity markets, and that will also expand the equity markets. So if you see this chart, Sensex from the last 45 years has compounded at a 16%
Vishal,
CAGR.
Vishal, sorry to interrupt you. I think we are still on the first slide.
You are still on the first slide?
Yeah.
Arey, I'm able to change. I'll just stop sharing and reshare. Just give me a second. Is the screen visible now?
Yes, the screen is visible.
And can you see the shuffling?
Yeah.
Okay, okay. So I'll just recap what I was saying. I'll be a little fast. So I'm saying there are longer term trends, there are medium term trends, and there are short term trends. So these are some of the a combination of these we use to manage our funds. And I will take you through these as to what are the long term trends, and then the medium and the short term ones. So among the long term trends that we see, Indians are under allocated to equities, even though equities have given the best return. So over the last 45 years, if you see, equities have compounded by 16% per annum, and none of the other asset classes have even come close. Even though, and the reason we Indians are underinvested in equities is people consider equities to be very risky. Ideally, the risk should be defined as loss of capital, and that too permanent loss of capital. But excluding that, if we on the longer term basis, volatilities won't matter much. We have seen n number of issues over the last 5 years, 10 years, 45 years, and all of these have created volatility, but not a permanent loss of capital. So I think if you look through this lens, then you will definitely see that equities are not as risky. Yes, more risky than certain asset classes, but not as bad. So there were bear markets in gold also. There were bear markets in real estate as well, right? So equities in the long term have done very well. Uh, if you had invested a certain amount, then you would have made substantially more in equities. So equities are still underinvested at only 10% of the amount that overall Indians have invested. So the largest is real estate, but we still think that real estate is best, even though real estate is just margin returns are just marginally higher than the fixed deposit. And if you see, the risk in equities over a very long term is not that high, right? Whereas risk in gold is high, and we have seen. If you will ask me that why is bank FD stated as high risk, There are a lot of banks, a lot of rural regional banks, there are a lot of cooperative banks where there is enough risk even in a fixed deposit or a savings bank account, right? Whereas in equities, if you invest in right funds and right kind of stocks, then the risk is not that high on the long term. And equity returns are actually linked more to inflation and less to real GDP growth. This is the comparison between US and China, US and Japan. Japan has given much lower returns in equities because of lower inflation, whereas US has given mid single digit returns over a very long period of time. So, and large part of this is due to inflation. In India, we are targeting between 4 to 6%. And if you see most of the developed countries, they are targeting at 2%. So there is a huge difference. So that is one reason why we are a faster growing economy, number one, relatively, and we'll have faster inflation. So even in this budget, if you see, we have targeted 10% nominal GDP growth. None of the large economies globally, you will have 10% nominal GDP growth, even with such high inflation. So, yeah. And this is the real return of Nifty 500 over the last, say, about 13 years. And we are seeing there is enough, there were very short span of time where we had negative returns. Otherwise, most of the years we've had positive returns. And even if there is a spike downwards, it bounces back quickly so that you at least come to zero. Some of the economies, as they grow, as they become larger, the share of knowledge-based sectors increases. This is an example from Nasdaq, and if you see, Nasdaq has seen a huge expansion in multiples. So the 3.7 times has actually become 7 times. So we are ascribing a higher valuation multiple to companies that are able to innovate and are able to target a larger market, a larger audience. So all the platform-based companies that we have seen proliferate over the last 15 years in India and globally over the last 25 years, a lot of these companies have got huge operating leverage, and hence they command a huge multiple, much higher multiple. And this is the reason why, as the economies improve, as they grow, the share of services sector also increases. And India is very well placed. India today, 65% of the GDP comes from consumption. We are services the largest contributor to the GDP. And as we are able to infuse more money in R&D and innovation, I think our multiples for a lot of our companies should actually sustain or improve in these specific sectors at least. Indian government has been spending on capex. We have substantially increased our capex. So if you see, in 2020, we were spending just 2.5 lakh crores on defense, road, and railways, and that has grown by 3x in last 5 years. We're closing almost touching 3x. So that is 7 lakh crores. So this is a meaningful jump. And if you add water and electricity and housing over here, then it is meaningfully higher. Last year the growth in capex was slightly muted, but I think if we are able to go through this cycle this year of pain, where we are going to contract the fiscal deficit meaningfully from 4.8 to 4.4%, after this I think we should be very well placed in terms of capex growth as well. I'll give you a few examples as to why capex is needed and why it is a big driver of any economy. Today, we are going to construct a 600-kilometer train, a high-speed train from Mumbai to Ahmedabad. The cities are not important. The distance is 600 kilometers only. If it works fine, then you can cover the distance in 2 hours. If you operate the train at the designed speed of 350 kilometers per hour. So what this leads to is people who are working, say, 1 hour from by using the high-speed rail, bullet train, people who are working by 1 hour away, say between Vapi or Surat, they can come to Mumbai in 1 hour, to BKC in 1 hour and go back in 1 hour, right? The time taken from Churchgate to Borivali in car is 2.5 hours today in the evening. And people are asking, do we need high-speed trains? We desperately do. India is a hugely populous country, and we need more urbanization. Our urbanization will happen when we decongest the existing cities. You will be able to decongest the existing cities when people will be able to come work here and go back, and we develop the infra in some of these smaller cities. So transportation is very important. And in China today, 44,000 kilometers of high-speed rail is operational. So 44,000 kilometers of high-speed rail is currently operational in China, and we are still debating, do we need 600 kilometers of high-speed rail? So we desperately do, and hopefully at some point in time we will add more high-speed rail as well. And I had briefly touched on water. So water is a huge driver of capex in India. Uh, uh, I think you will be amazed to know that 25% of the households in India, total of urban plus rural combined, 25% of the households don't have tap water connection. And you, since you don't have running water, tap water flowing through, it is difficult to build sanitation. And since you can't build sanitation, it creates a host of social issues. So we have been able to search water on the dark side of moon, but somehow we have not been able to provide enough water. So the government is desperately trying, and they have launched the Jal Jeevan mission to connect all the households with tap water, and hopefully by 27 we should be able to achieve that. So it's a very important journey. So what I was trying to summarize is, capex is a big driver for India, and the velocity of money in capex is very high. Every 100 rupees that you invest in railways generates economic value of 500 rupees. So we are rightfully investing here. These were the long term views. I can recap them for you. We are underinvested in equities. We in equity returns are linked more to inflation, and we should have a steady inflation of 4 to 5%. So we should have at least that sort of a growth, and we are spending more on capex. The medium term views, we are seeing that we've had very good growth over the last 5 6 years, and even if you consider from 2014, we've had good growth, but we are seeing some slowdown, and a lot of the slowdown globally is due to lower population growth. And incrementally, the developed countries are have become very wary of immigration. So if you don't have population growth, then adding too much of productivity growth, they are already very productive. They can't improve productivity from there, from where they are already at a much higher level of productivity. And consumption is also very high. 75% of GDP in Europe is driven by consumption. 72% of the GDP of US is driven by consumption. So they will have to invest in manufacturing, they will have to invest in high tech services, but they don't have enough population. The population growth is happening in areas which are underdeveloped relatively. So over the next few years, the global GDP growth will slow down. The Even if we didn't have any issues on tariff, we would have still seen a slowdown in GDP growth. If you see within India, uh, the top 7 states the have the replace fertility rate of one below 1.5, and 2 is required for the replacement of population, right, for the right replacement of population. Whereas if you see Bihar is working at 3. So naturally Bihar has much higher replacement rate, fertility rate, and hence they are able to add net to the population, whereas southern states are actually receding the population. Their population is actually in a decline, and hence people are looking out for work. But we need to create more avenues there as well, in addition to the migration that we are seeing across the country. So we need to have slightly higher fertility rate in the southern states and slightly less fertility states in UP and Bihar, for the balance to sustain at 2 for India as a whole. Growth globally because of exports have stagnated, and it will decline actually over the next decade because of the tariff and protectionism that is being adopted by most of the countries globally. India is actually scaling up its manufacturing at this stage, and hence India is more at risk because this protectionism and local manufacturing is growing and taking prominence at a time when India is looking to export more. So that is a challenge that we have to face. One sec. Yeah, but we are very well placed on the currency side because the external accounts are very well placed. If you see current account deficit, we at some point in time we were almost touching five. We are down to less than one. This year also we'll be closer to one. Services exports have increased substantially. There might be some risk if we start taxing services, but there won't be enough people available elsewhere in the world with such good coding and English skills. So I think we should be able to have an edge on services as well. And we have been able to diversify a little our source of energy. So net oil imports have come down. Oil prices have also come down. And even if due to geopolitical issues, if we see a spike in prices, they may not be able to sustain those levels because of energy transition that we are seeing. By energy transition, what I mean is, if you take China as an example, every 60 cars that are sold in China, or every 100 cars that are sold in China, 60 are electric, right? Hybrid plus battery, plug-in hybrid. So if you see the pace at which electrification is happening for mobility across the world, we are at a stage where the requirement of crude for petrol and diesel will come down. In India, what is happening is we are increasing the use of ethanol, we are increasing the use of renewables, we are increasing the use of for railways. Railways are now 100% electrified, 98% electrified. So the energy transition that is happening globally and in India is here to stay, and hence even if we see a spike in crude, it should not impact our current account much. So currency is really well placed for India, and this is the medium term trend where the demand for services will continue to remain high. The demand for high tech manufacturing even in India will continue to remain high, and which has meaningful implications for automobiles and real estate. Now, even if you see the manufacturing of manual efforts and more usage of robots, this is primarily in China. If you exclude China, then the adoption of automation is not significant. Whereas uh, automation is actually supplementing the human capital rather than taking away the jobs. And these are some of the sectors. If you see at the darker dots, where the impact of the dollars is not very significant. Whereas if you see in certain sectors that are in lighter dots, light blue dots, where the impact of automation is actually meaningful. But this is where it is helping us, not replacing it. And we are firmly of the belief, at least at this stage, that AI will lead to better productivity and consequently more applications and hence more jobs. So the demand for white collar workforce will remain high because of these factors. And if you see a reshoring of manufacturing in the Western countries, also will lead to higher demand for Indians, right, to go there and operate these machines. And manufacturing are the best paying jobs. They are very high quality jobs, and they have, in general, they are much more. The salaries are much higher than services. Now, since the demand for white collar services in India is high, this leads to direct impact on certain sectors and indirect impact on a lot of sectors. So, high end retailing, real estate, leisure and travel. You would have seen the way hotels prices are, the way ticket prices are for airways. I think all of this shows the demand for high end hospitals, demand for wellness. All of this is a function of very good salaries and more number of such high-end jobs that are being created in India and abroad. Now comes the short-term perspective. This is where I think the challenge today is. Relatively, Europe is doing much better than US. If you see the economic data for the last 6 7 months, Europe has done far better than US. The US has been in a state of slowdown, and what the president is trying to achieve is they're saying that we have about 8.5% as fiscal deficit. To put a context, that India had 4.8% in FY25, and we are targeting 4.4% in FY26. So with this sort of a deficit and huge trade imbalance, US imports $1.2 trillion of goods every year. So they are of the opinion that we need to manage this somehow. It's gone out of hand, and hence the fight to actually reduce to impose the tariff and to reduce imports. So this is what they're trying to do. But if you see whether this is the right strategy or not, there are the I think the verdict is still out there as to what is the right strategy. But I think US as a whole has felt that something has to be done. So the Trump administration in the first term, Biden administration, as well as the Trump administration in the second term, out of these three terms, we are seeing incremental pressure on China. China has put up capacities in Middle East and Southeast Asia to service US, but even those capacities are being taxed. So India does have an opportunity. The levy on India by the US is lower than the levy that they have put on some of our peer countries, or what they have put in general in a developed economy. So if they've put a lower tariff on a developed country, uh, but they've put 26% on India, so it will not matter because the cost of producing at this developed country is very high. So just this tariff differential will not support. Whereas for India, if you have 26%, even if we are able to pass on 20% or 22% immediately and say balance 5-8% gradually, even that will be a good case scenario for India. Because for others, they will have to take a much steeper price hike to pass on, which they won't be able to, and hence India should be relatively okay. Uh, Also, on the economic activity, there is some improvement as compared to what we saw in the second quarter of last financial year. So, from the lows of July, August last year, I think we are improving. There is some stagnation that we are seeing in January and February, but nonetheless, we are on an improving trajectory. So, the risk of slowdown has abated in India. And in the short term, what we will be tracking is how will the US manage the dollar. So till now, what used to be the case was, uh, anytime there is panic in the world related to anything macro, people used to go buy US dollars. And this time they're actually selling US dollars with so much of uncertainty in the global markets. And how does China react to the US is also very important. If China only reacts by the way of higher tariffs, it might not be as bad for India as if in the scenario when China decides to depreciate the yuan. So yuan has depreciated in the last 1 year by 5% from 7 to 7.32, but incremental depreciation should be very minimal. And if that happens, then it is good for India, because the reason is that if China depreciates yuan, they become more competitive than anywhere else in the world. And we India INR has depreciated more than the yuan over the last few years, and we expect this trend to continue. But watching yuan will be very important. U.S. government has said that, German government has said that they plan to invest $500 billion over the next 8 to 10 years on infrastructure, and this will also imply a lot of spending on defense. So, and then there will have to be associated spending in electricity and transport and the likes. And so we think over the next 10 years, Europe will have to spend about $2 trillion in capex, including renewable energy and defense and general manufacturing. Now, this will create enough opportunities for companies that are able to service this, and we do have some stocks that should benefit from this outlook. The other thing is, so India as a whole was running a tight fiscal policy and a tight monetary policy. So we still continue to run a tight fiscal, but thankfully we have relaxed on the monetary policy, and that is very important. The government of India has told banks that you can go out and lend. Please don't worry about unsecured. The government of India has said that we will also help you create deposits, and the government has deposited about 70,000 crores of their money. RBI has deposited that money in the banks, and then we were running a tight fiscal that we continue to do, but on the monetary side we have improved meaningfully. We might also see a rate cut soon, and the key issue here is that has the government shifted to consumption from infra. Now, what the government had said was that states will continue to do local level consumption, and we will continue to focus on infrastructure. So, has that thought changed? Is very important to understand now, and we think that fiscal continues to be tight, but monetary, definitely there has been a relaxation. Indian markets have always been traditionally more expensive than the global peers, and this is because of higher growth, number one. And second, and more important, this is because of higher return ratios. So if you look at ROE of Nifty 50, we are at 20%, whereas if you look at Hong Kong, they are at 6%. So basically what this means is that the return on equity in India is much higher than the cost of capital, whereas in China is lower than the cost of capital. If your returns are lower than the cost of capital, which would imply that you are incurring an economic loss, right? So this economic loss is not a scenario in India. We are doing much better. So I think hence the multiples have been slightly higher, and I think that scenario will continue to be. At 26,400 in Nifty in September of 24, that was an exaggerated level. We were also expecting a pullback, and that pullback has come in. Markets have a habit of extending on both the sides of the true value, and the market had extended at the upside much higher than its fair value, and on the downside also I think it is trying to do that as well. Somewhere in between is the true value. Like every stock where we can find out its profit and its CPS, and we give a multiple to the CPS to get a fair value of the stock, we can do the same exercise for Nifty 50. And if we do that exercise, then this year, this financial year, Nifty should do an EPS of about 1180, and next year about 1300 to 1320. So even if you consider 1180, for the sake of calculation, if you consider 1180 and if you give it 20 times, you come to 21,740, it's 760, right? So that is where I think we should be somewhere there. And when it comes to, if you give a multiple to FY27, March 27 EPS, then 1300 into 20 should be 26,000. Now, this is a broader range. The point here is that multiples are 1 year forward. So in March of 25, we should be, say, somewhere around 18 times or 20 times as per your convenience on March 26 EPS, and we are slightly higher than where we should be. And if you consider March 27 EPS, which should be the case in March of 26, we should be closer to 26,000. We are closer to 23,000 today. So I think this is a good way to understand as to what is the reference point. We are expensive or cheap, and where should we be where should we be going? So I think this is how we are thinking about the markets and valuations. Globally, DXY correcting is generally good for EMs and is generally good for commodities. And I think once this panic settles in a couple of weeks, I think this is how it could play out. In this sort of a search for safe haven, the US yields have fallen from 4.4% to 4.15%. That is a concern. Crude oil declining is positive for India for the fiscal accounts, but negative for India for the companies who are focused on Middle East. And if you look at AI and DeepSeek, so as an engineer, I can tell you I've worked on some of these models, and it's mind-blowing in terms of what these applications can do. But they are still far away from calling them actually artificial intelligence. They are still in a mode to augment the abilities of people rather than thinking by themselves. Nonetheless, this is if this actually picks up, then it could pose some threat for the longer term for services. And so, as I mentioned, on the domestic side, monetary policy has been eased. That is very good. We have meaningful gains in gold because the prices have gone up. And there was a statistic that India has got so much gold as the 7 central banks combined in terms of the household gold. Would be actually much more than that, but that is very good news for the country. And so this is my summary, and then we'll open the floor for questions. So market is trading at about, say, 19 times FY27 earnings. So that is important. In a calibrated manner, we think the investor should start looking at lump sum opportunities as well. And recent developments have mostly been positive, right? RBI policy, Europe stimulus, the DXY correcting, all of these things are positive for risk assets and primarily equities. US will get into a recession. They are trying to do that via, if they get into a recession, US Fed will cut interest rates and they will have some relief on the interest payments. So I think that is a primary concern in the US. And globally, technology adoption and high liquidity will continue. So there could be some, some jitteriness for people to buy high-end consumption and IT, but I think these sectors should do very well. So in the next 1 year, we prefer large caps over small caps over mid caps. Mid caps are too myopic. Such a large category confined to just 150 stocks, that's a problem. And core equity fund, we are focused on large and mid and a little bit of small, but we try to allocate more for large and small and slightly less in mid. So mid is very expensive, trading at 28 times FY 26 earnings, whereas small cap is still okay at 20 times, and similar to Nifty at about 19.5 times. So market cap has kept its trend with the GDP as well. And for US as well as China, we've seen as the economy grew, there was a significant jump in the interest rates there, but which also shows the correlation. Whereas for India, that story is yet to play out, and hence the opportunity. So large caps provide stability. I think I'm sure you guys know all this. And Nifty and large and mid, the exposure to top 50 stocks, the ability to choose from the top 250 stocks also gives you diversification in terms of selecting sectors that are not represented by Nifty 50. So that's a very important attribute. And large and mid has outperformed Nifty 50, though mid cap has outperformed large and mid, but that is due to a slightly higher volatility in mid caps as well, and much lower volatility in large and mid relatively. And these are so the number of times large and mid was returns over 15%, was 67% of the time returns have been over 15%. It's a very meaningful return of 15%, and 67 of the time it was. Mid cap was also there, much higher, but mid cap also suffers from much higher stock concentration and significantly higher valuation. So I think large and mid is better placed. And this is the approach that we follow while investing, while selecting a stock and building the portfolio. There has to be a very dynamic approach to fund management. We don't buy and sit forever thinking that at some point in time stocks will do well. If we see in the long term or medium term the stock is not going to do well, then we'll chuck it out from the portfolio immediately. The portfolio has a higher number of stocks, and it gives stability to the fund. And if you see a lot of reputed fund managers have actually run very large number of stocks in the fund. And if you look at, we follow the macros very closely. There are a lot of fund managers who say that you shouldn't follow the macros and only the stocks. We are not of that belief. We believe that watching macro is equally important. And this is a 360-degree approach that we use. We think some of the sectors where we think should do well, some of the sectors where we think it may not do as well. So this is Bandhan Core Equity Fund, and the exposure to large caps is closer to about 50%, and the exposure to small caps is closer to about 13%. It's actually the other way around. I think there's some mistake in the way I have written. So this is broadly it. So this is this is an important slide. How we think about the stocks in the portfolio. We have classified the stocks into value stocks, high growth and quality, and thematic and cyclicals. So within this bucket, right, within capital goods, I may shuffle the stock, but we would largely have cyclicals at close to 30%. Optional value stocks and value stocks, these stocks have historically generated very poor returns. They continue to be a small portion of the total fund, and high growth and quality generally constitute the highest weight, and that is what we will keep maintaining. So this is the portfolio allocation. High growth quality investing, I think this is how we look at, rather than plain vanilla large mid small. And this is how the portfolio looks currently. So if you see, it's a defensive portfolio as of now. We've taken a few calls which have higher weight, but largely it's a defensive portfolio. And we are overweight on pharmaceuticals and healthcare. We are overweight on metals and mining. We are significantly underweight on oil and gas, in IT and capital goods. Being underweight on capital goods and IT and auto, we were underweight for quite some time, and that has helped the fund a lot. So yeah. So this is how we are placed. And in case you guys want to see, returns have been fairly strong versus the index. So this is where I would like to end, and I will open the floor for Q&A.
Yeah, thank you. So the floor is open for Q&A. Anybody who wants to ask any questions can either put it on a chat or on the Q&A section.
So I think there is a question in the chat in terms of on China tariff of 38, 34% by the US. Nifty will be 19,000, 17,000, 15,000. Sir, I don't know if it is so directly correlated to answer this question. I will not be able to answer this. See, I can tell you what will happen is this is a retaliatory tariff. US cannot sustain such high tariffs for their economy. Neither can some of the other countries. At some point in time, all of these people will rush to the White House, and most of the countries are doing so. India is working for a bilateral agreement between the two countries. We should have that by December of 25, by the end of this year, and that should take care of this incremental tariff of 26% that US has levied. Similarly, a lot of other countries are also rushing to the US this year. Vietnam Prime Minister is meeting POTUS. Then Australia is also meeting this week. So I think, I'm sure there is a host of meetings that will take care, and we may not end up with such high tariffs. There was some unfairness to the US, but that was a large part of it was their doing. And China has retaliated in a very big way. I think a lot of these things will settle down, and consequently, the markets will also take such things into account. But let's see. Second question is, do we get the slides or recording? I think we can send the slides across. We're not sure of the recording. I'll check.
So we'll have this, you can follow HDFC Securities on YouTube. You'll have this recording posted over there.
Okay.
Vishal, I think because of time constraint and we don't have any questions, probably we can end the call. Any last thoughts, for the investors, before we end this call?
See, we are constructive on the markets. I think there are enough opportunity for us to look at. And we are very selective in terms of sectors and stocks. I think that is the reason why we have been able to beat the markets and our peers. And hopefully we are able to maintain such skills in managing our portfolios. There is a question on views on IT sector. I'll just be very fast on it. See, this is a sector which has got very significant structural strengths. In the near term, yes, there are two risks. One is AI, and one is this US economy slowing down. There have been other cycles that the sector has faced and has come out stronger. I think this is how it could play out in the medium term. For now, we are underweight on IT. We have been underweight for some time now, and we might change our stance later in the year. Not as of now, but we are keeping a close tab on it. Thank you.
Sure, Vishal. Thank you so much, Vishal, for taking out the time and
Thank you.
sharing the market insights with us. And I'm sure this is going to help the investors in terms of taking the right decision. And
Yeah.
probably this is the best time wherein the investors can add on to their SIP, add on lump sum, because the market has also corrected, and this is the right time for the investors to get in the market.
Indeed. So, yeah.
Yeah. So thank you everyone for joining in.
Thank you. Thank you.